Today, we're diving into a really interesting shift in India's economic strategy, and we're using the 2025-26 Economic Survey as our guide. We're going to look at why the Reserve Bank of India decided to move to what's called a neutral monetary policy, and what that really means for the economy.
So here's our game plan. First, we'll get a feel for the choppy global economy that India was dealing with. Then, we'll see how India's own strong performance gave it some room to breathe and make a change. After that, we'll break down what this neutral stance is all about, see how that move rippled through the financial system, and then we'll wrap up by looking at the balancing act that lies ahead.
All right, so first things first, let's set the stage. You know, no country's economy exists in a bubble, and India's policymakers were looking out at a world that was, well, pretty darn uncertain.
This quote from the survey just nails it. It's kind of like trying to sail a ship when the weather is unpredictable and the maps keep getting redrawn. You've got geopolitical issues, supply chains are a mess, and different countries are growing at totally different speeds. It was a real puzzle for central banks everywhere.
And what's super interesting is how everyone reacted differently. You had the big, advanced economies like the US and in Europe, and they started cutting their interest rates because inflation was finally cooling off. But then you look at the emerging markets, and they were all doing their own thing, trying to protect their own growth from all these global shocks. This created a really volatile situation where money could just rush in or out of a country at any moment.
So, with all that chaos going on globally, how did India manage? Well, the story here is actually one of incredible strength, and that strength is exactly what opened the door for a major policy change.
The first part of that story is just solid growth. I mean, an estimated 7.4% real GDP growth is a huge number. And the key thing to remember is that this was powered from within. People and businesses inside India were the ones doing the spending and investing, which built this really strong economic foundation.
Now, the second piece of this puzzle was maybe even more important. Inflation dropped a lot, all the way down to 1.7%. This was a massive change, mostly because food prices started to stabilize. Getting a handle on inflation like that was basically the green light the Reserve Bank of India, the RBI, had been waiting for. And they didn't waste any time. With the economy growing nicely and inflation under control, the RBI stepped in and cut its main interest rate, that's the repo rate, by a full 100 basis points. This was a clear message: let's make it cheaper to borrow money and keep this engine humming.
Okay, this brings us to the real heart of our story. The rate cut got all the headlines, but the bigger deal was the change in thinking behind it. The RBI was fundamentally changing its whole posture. So what on earth is a neutral monetary stance? Okay, think of the economy as a car. For a while, the RBI was in an accommodative stance. That's like having your foot on the gas to make the car go faster. A hawkish stance is the opposite. It's hitting the brakes to slow things down, usually to fight inflation. Neutral is like taking your foot off both pedals. You're just coasting. It tells everyone the RBI isn't trying to speed up or slow down the economy anymore. It's in a wait-and-see mode, ready to tap either the gas or the brake if it needs to. It's all about flexibility.
And you can see this pivot happen right here on the timeline. In June, the official language changes. They go from accommodative to neutral. Then over the next few months, you see the rate cuts kick in, bringing the repo rate down to 5.25% by the end of the year.
The big thing to get here is that this wasn't just one move. It was a coordinated, three-part plan. Step 1, change the stance to signal flexibility. Step 2, actually cut the rates to make money cheaper. And Step 3, which is super important, was to make sure that money was actually available. They did that by pumping more liquidity into the system, which basically means they made sure the banks had plenty of cash to lend out.
Now, when a central bank makes a big move like this, it's not just an abstract policy change. It sends ripples across the entire financial world. So let's take a look at what those effects were.
And what the survey shows is that the results were, frankly, fantastic. First off, the banking system got a whole lot healthier. That 2.2% number for bad loans, or NPAs, is a multi-decade low. That is a massive sign of stability. Second, the rate cuts actually worked. They trickled down through the system, making loans cheaper for everyday people and businesses. And finally, the banks themselves stayed really well capitalized, meaning they had a strong safety net to handle any future problems.
So what's the bottom line here? It's pretty clear. All these moves created a financial system that wasn't just treading water, but was actually stronger, more flexible, and better prepared for whatever came next.
So where does all this leave us? Well, after successfully navigating a tricky 2025,
India is now facing the next big challenge.
And this right here is the million-dollar question for any central bank, right? The neutral stance gives you options, but it doesn't solve the core problem. You have to keep the economy growing, but at the same time, you have to make sure inflation doesn't come roaring back. It's a constant, delicate balancing act.
And this final line from the survey just sums it up perfectly. This tightrope walk. It's such a great metaphor for what comes next. It's all about finding that perfect balance between pushing for growth and maintaining stability. The time for big, sweeping policy changes might be over. Now it's about having a steady, precise hand on the wheel to navigate the path ahead.